Welcome back to Principles of Accounting. We are going to go over some important accounting rules and concepts that you all will need to know to be successful in this class. Learning the rules, GAAP, which stands for Generally Accepted Accounting Principles. And what this is just the rules and guidelines that accountants must follow. They provide guidance on how accountants should prepare the financial statements. So let's move on to FASB. FASB stands for Financial Accounting Standards Board. And what FASB do is set the GAAP, or the Generally Accepted Accounting Principles, aka the rules that the accountants must follow. The FASB sets those standards for businesses within the US. And let me rephrase that. Not just businesses within the US, but for-profit businesses in the US. FASB sets those standards. And I wanted to make an emphasis on that because government will have its own accounting standard board who will set its standards. It's actually called GASB. But the FASB, Financial Accounting Standard Board, sets the GAAP, Generally Accepted Accounting Principles, for-profit businesses within the US. So let's move on to IASB, which stands for International Accounting Standard Board. And what they do is set the standards for companies outside of the US. So international companies, they will set those standards for those companies. So Generally Accepted Accounting Principles is simply a collection of accounting standards, principles, and assumptions that define how financial information is reported. So pretty much what I told people, GAAP is like the rule book for accounting. It tells accountants what to do, why to do it, and how to do it. So accounting in GAAP is based off of these 4 assumptions. One of them is the monetary unit assumption, which requires that financials are expressed in a single currency. So for a business within the United States, it will be expressed in the US dollar. Time period assumptions allows a company to report its economic activities on a regular basis, such as annual reporting. Some companies actually do monthly reporting for internal purposes, but they were trying to get a loan or something, they would use their annual reporting for that, which we'll touch on that a little bit more when we get to financial statements. And then we have our business entity assumption, which says that businesses are viewed as a separate entity from their owners, creditors, or other businesses, such as the LLC, which I talked a little bit about this in the last video titled Types of Businesses. If you have not watched it, go check it out. And then the going. So then another assumption we have is the going concern assumption, which requires that financial statements be reported, assuming that the business will continue to operate. So the financial statements will have to be reported with the thought process that the business will last for at least another year. So let's go over some important principles in accounting, because everything that you learn in this class is going to be tied to one of these principles. It's going to come back to one of these principles, every single thing that you learn in this course, okay? So the first principle is the measurement principle, which determines the amount that will be recorded or reported, okay? So then we have the historical cost principle, which says that transactions are recorded at the initial transaction price and do not normally change until another transaction occurs. So if a company purchases a building, that's a transaction. The purchase of that building is a transaction. So that building will be recorded at the amount that the company paid for that building at that time. So that building will remain on our books at the initial transaction price and will not change until we were to have another transaction that will change it. So if we were to add something to the building, then that's a transaction that will change the amount that we have recorded the building for. So it will increase the amount that we recorded the building for with that transaction. But if we do not have that transaction, then the building must stay at the cost that we recorded it at, okay? Now, these next two principles are the two very, 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 very important principles in accounting, and most of everything we learn will be tied to these principles, so listen up. The first one is the revenue recognition principle, which determines when the revenue is recognized, and that's usually when the service has been performed or product has been delivered to the customer. So GAAP says that, and let me remind you all what GAAP is. GAAP is the generally accepted accounting principles, which is just the rule books for accountants, okay? So GAAP says that when accountants record revenue in their books, they have to record it after the service has been performed or the product has been delivered to the customer. So we would not record revenue just when we receive that cash. Say that I'm a beautician and I require my clients to pay $50 in advance for their hair service. I would not be able to recognize that $50 that I received in advance as revenue because I have not performed that service yet. Or if I was a retail business or merchandising business, which means the same thing, retail and merchandising means the same thing. If I was a retail or merchandising business and I sold two-piece swimsuits, if a customer ordered a two-piece swimsuit and we have not delivered it to them yet, I will not be able to recognize that revenue until I actually deliver that two-piece swimsuit to that customer. So that's what the revenue recognition principle states, that we will not recognize revenue until the service has been performed or the product has been delivered to the customer. Super important. So then the next one is expense recognition principle, which requires that expenses be reported in the same year as its related revenue. So the expenses that we incurred for us to earn that revenue, we will record it in the same year. That's what expense recognition principle states.